Equity financing, raising funds by selling shares to investors. Introduction to equity financing, capital without debt. Equity financing allows companies to raise capital without taking on debt, which can be advantageous for startups and early stage companies. Bring in new investors. By selling shares in their company, companies can bring in new investors and access a new pool of capital. Fund growth and expansion. Equity financing can help companies fund growth and expansion by allowing them to invest in new projects and expand their operations. Definition of equity financing. Equity financing is a method of raising funds by selling shares of stock to investors who become shareholders in the company and have a stake in its success. It is often used by startups and early stage companies as a means of financing growth and expansion. Advantages of equity financing. No regular interest payments. Companies that use equity financing do not have to make regular interest payments, unlike companies that use debt financing. This can be a significant advantage for startups and early stage companies that may not have the financial resources to pay back a loan. No principal repayment required. Companies that use equity financing are not required to pay back the principal amount, unlike companies that use debt financing. This can be a significant advantage for startups and early stage companies that may not have the financial resources to pay back a loan. Expertise and connections. By bringing in new investors, companies can benefit from the expertise and connections of their shareholders. This can help the company grow and expand, as well as provide valuable insights and advice. Types of equity financing. Equity financing is a method of raising capital for businesses by selling ownership shares to investors. There are several types of equity financing, including rights issues, public offers, and private placements. Rights issues. Capital raising. Rights issues are a way for companies to raise capital by offering their existing shareholders the right to buy new shares at a discount. Existing shareholders. Rights issues offer existing shareholders the opportunity to increase their stake in the company and maintain their ownership percentage. Public offers. Raising capital. Public offers are a popular way for companies to raise capital by offering their shares for sale to the general public. Large companies. Public offers are often used by larger companies that are already publicly traded. Private placements. Capital raising. Private placements are a way for companies to raise capital by selling shares of their stock to a select group of investors, often used by startups and early stage companies. Limited number of investors. Private placements are sold to a select group of investors, typically no more than 35, and are not available for public purchase. Customizable terms. Private placements provide companies with flexibility in terms of the types of securities offered and the terms of the offering, making it a popular financing option. Key concepts in equity financing. Subscription. Subscription is the process of offering shares of a company to potential investors for purchase, usually through a prospectus or offering memorandum. Underwriting. Underwriting is the process of guaranteeing the sale of shares by purchasing them from the issuing company and reselling them to investors at a profit. Shareholder approval. Shareholder approval is the process by which a company obtains approval from its shareholders for an equity financial transaction. Financing transaction. Discounted equity. Discounted equity is issued by a company at a price lower than its current market value, usually to attract new investors or to raise capital quickly. Subscription. Subscription is a process by which investors purchase shares in a company's stock offering, typically through a subscription agreement that outlines the terms of the investment. Underwriting. Underwriting is the process by which a financial institution agrees to purchase any unsold shares in a company's stock offering. Oversubscription. What is oversubscription? Oversubscription happens when the demand for a company's stock offering exceeds the number of shares available for purchase. This indicates high investor interest in the company and its stock. Reasons for oversubscription. Oversubscription can happen when the company is offering its shares at a discount or when there is a lot of demand for the company's stock due to its strong performance or growth prospects. Undersubscription. Undersubscription is a situation where a company's stock offering is less popular than expected, with fewer investors willing to buy shares than shares available. Shareholder approval. Equity financing. Shareholder approval is required for certain types of equity financing, such as rights issues that allows existing shareholders to buy additional shares in the company at a discount. Rights issues. Rights issues are a type of equity financing that allows existing shareholders to buy additional shares in the company at a discount. Shareholder approval is required for rights issues to ensure that existing shareholders have a say in the company's decision to issue new shares. Rights trading. Rights trading is the practice of buying and selling rights to purchase shares in a company's stock offering. Investors can make a profit by selling these rights to other investors. Discount. A discount is a reduction in the price of a company's stock offering, which can be a way for the company to encourage investors to purchase its shares. Conclusion. Equity financing is a way for companies to raise capital without taking on debt. There are several types of equity financing, including rights issues, public offers, and private placements. Several key concepts involved in equity financing are subscription, underwriting, and shareholder approval. By understanding these concepts, companies can make informed decisions about how to raise funds for growth and expansion. Thank you.